In the high-stakes theater of global finance, some institutions are perceived as impervious, their foundations seemingly too deep, their influence too vast to ever falter. They are the titans, the bedrock of the market, yet even the mightiest among them can be brought to their knees not by external forces alone, but by a series of calculated gambits driven by ambition and shrouded in complexity that ultimately lead to a catastrophic, world-altering domino effect. This is the story of Lehman Brothers, a 158-year-old Wall Street behemoth, and the boardroom hubris that broke the world. For well over a century and a half, Lehman Brothers stood as a monumental pillar of Wall Street. From its humble beginnings as a dry goods store in Alabama to its ascent as a global investment banking powerhouse, it had weathered panics, depressions, and wars. By the early 2000s, it commanded respect, influence, and seemingly an unshakable position. It was, by all accounts, too big to fail. Yet, beneath that golden veneer of invincibility, a precarious game was being played, a series of increasingly risky moves that would eventually bring this titan to the precipice, vibrating ominously, ready to shatter. Lehman's journey to the abyss began not with a sudden plunge, but with a strategic shift, a deliberate pivot driven by the pursuit of higher yields. Traditionally, Lehman excelled in fixed income markets, a stable, albeit less exhilarating business. But as the financial landscape evolved, the allure of the booming real estate market, particularly the burgeoning subprime mortgage sector, proved irresistible. Management made a calculated decision to aggressively expand into this highly lucrative, high-risk world. They poured billions into originating and securitizing mortgages, especially those offered to borrowers with poorer credit histories, who were once considered too risky. The strategic imperative was clear: prioritize short-term profitability and market share, leveraging the booming housing market for rapid growth. Long-term stability, it seemed, was a secondary concern to the immediate rewards of this high-octane gamble. This aggressive expansion transformed Lehman, fattening its balance sheet, but fundamentally altering its risk profile, replacing solid ground with the shifting sands of an unsustainable boom. As Lehman's exposure to subprime mortgages mounted, so too did the need to manage perception, both for investors and regulators. This led to the meticulous and ultimately deceptive art of obfuscation. The primary tool for this was the collateralized debt obligation, or CDO. Imagine thousands of those risky red data streams representing subprime loans. Instead of leaving them exposed, these were bundled together, sliced into tranches, and then magically re-rated by credit agencies. Through this financial alchemy, packages of inherently toxic debt were relabeled as safe investment-grade AAA assets. It was a sophisticated shell game, making high-risk assets appear palatable, even attractive to unsuspecting investors worldwide. But the deception didn't stop there. Lehman also heavily employed repo 105 inches transactions. This involved temporarily selling assets to European banks at the end of financial quarters, with the intention of buying them back shortly after. These were not true sales but rather short-term loans. Yet they were accounted for as sales, allowing Lehman to temporarily remove billions in debt from its balance sheet, making its leverage ratios appear healthier than they actually were. This intricate dance of moving assets on and off the books and cleverly repackaging risk created an illusion of stability, successfully deceiving regulators and lulling investors into a false sense of security, all while the underlying vulnerability grew ever larger. The carefully constructed illusion began to unravel with brutal speed. The housing market, which had fueled Lehman's aggressive expansion, stalled, mortgage defaults soared, and the value of those meticulously packaged CDOs plummeted. The underlying assets, once disguised as golden eggs, were revealed to be toxic. The market, now wise to the deception, lost confidence. Suddenly, counterparties, banks and institutions that had lent to Lehman, began demanding collateral, billions in cash and highly liquid assets to cover their exposure. Lehman, having hidden its leverage through schemes like Repo 105, simply did not possess the necessary funds. The atmosphere in its boardrooms became desperate. Over frantic weekends in September 2008, closed-door negotiations ensued. Lehman's executives pleaded for a lifeline, searching for a buyer, a white knight to save them. But the government, having bailed out Bear Stearns months earlier, drew a line in the sand. The political will for another taxpayer-funded rescue had evaporated. It was a betrayal in the eyes of Lehman's leadership, a stark and fatal refusal that sealed their fate. And so it came to pass. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. With over $600 billion in assets, it was, and remains, the largest bankruptcy filing in U.S. history. The collapse was not merely the downfall of one institution, it was the epicenter of a global earthquake. The shockwave of its failure ripped through the interconnected global financial system, toppling institutions, freezing credit markets, and igniting a crisis that would plunge the world into the Great Recession. The domino effect, predicted by few, but experienced by all, was horrifyingly real. The Lehman domino serves as a chilling testament to the terrifying reality of systemic risk. It's a stark reminder that in an increasingly interconnected global economy, the failure of one seemingly unassailable titan can trigger a cascade of unforeseen and devastating consequences. It exposes the perilous allure of corporate greed, where short-term gains are prioritized over long-term stability, and where complex financial mathematics can be wielded not to understand risk but to mask it. The most profound lesson, perhaps, is the chilling realization that the architects of the global financial system, the very executives wielding these intricate models, fundamentally misunderstood the inherent vulnerabilities and the true risk of the complex mathematical structures they themselves created. The hubris of believing you can control infinite variables, or indefinitely obfuscate underlying fragility, ultimately broke the world. Join us next time on the Boardroom Gambit, as we deconstruct another high-stakes play in the world of corporate strategy. If this analysis of Lehman Brothers' downfall resonated with you, be sure to like this video, share it with your colleagues and friends, and subscribe to the Boardroom Gambit for more strategic insights into the plays that shape our world.